about now. All right, we are back. Day 3. And thank you all for showing up. All right. And yeah, I appreciate you guys. And you guys, you know, a lot of you have been telling me, oh, thank you, Joy. Thank you. But you know the thank you I want from each and every one of you. The thank you that you passed all your exams. Okay? Within this period. That is the thank you I want to get from all of you. All right. So that being said, yes, it's going to be requiring extra effort, putting in extra effort, even outside the class. After the class, you need to go back, you know, read or do your necessary studies so that when we come to class, you are on top of what we are doing. So that's the thank you that I want to go. Anyways, we're going to continue on life insurance and we are moving on to chapter 8 tonight. However, I want to do a very quick recap because I noticed that yesterday's chapter was a little bit of struggle for many of us. I understand, you know, when it comes to the concept of ACB, you know, the adjusted cost basis concept, is always like, you know, when I look at myself, you know, talking about ACB now, and I know it, I struggled with it too. In fact, even the abbreviation, when I see ACB, at the time I was studying for the exams, I struggled to remember what the acronym stands for, right? Now I'm saying, and that's one of the reasons I'm intentionally using the complete phrase over and over again, adjusted cost basis. You guys hear me saying it over and over again. That is for a reason, because I want you guys to get familiarized, to get familiar with the actual concept. Okay. So if you are feeling the way you felt yesterday, that's typically okay. But I just want you to like keep it simple in your head. Don't over process it. Okay, because a lot of you are wondering, what is ACB? What is this? And now and towards the end of yesterday's class, we introduced NCPI, which stands for Net Cost of Pure Insurance. So before I proceed into chapter 8 of today's class, I want to do a quick recap of what we did yesterday. And hopefully it helps connect the dots for any of you that is still struggling with any aspect of all the concepts we talked about yesterday. Okay. So yesterday we talked about exempt tax principles, and the exempt tax principles, like I said, and I even showed you guys in the illustration software, is typically measured, okay, from the day the policy was issued and every policy anniversary date. Violet, can you help me mute everybody, please, except myself? Don't mute me, okay? So that is exempt test principles right there for you guys. And like I said, it's a gatekeeper, okay? Don't worry about exempt test because you're not going to be asked to calculate any exempt test. No. It's just a concept, a principles that you need to know it's there. The reason is because, you see, when insurance policy, especially universal life policy, is overfunded, there's tendency that it will grow so much that it will be exposed to taxes. And that will, you know, kind of eliminate the benefit, the objective of the life insurance principles or policies, or the intent of the policy owner. So what the insurance company does is that they put that gatekeeper there so that any time that the policy is growing so much, it will trigger the awareness of the insurance company that, hey, this policy is growing so much. So the insurance company will now reach out to the policy owner that, okay, your policy is getting close to, you know, breaking the ceiling of the exempt test lead. Then the insurance company will recommend different strategies that can be taken to mitigate that. One of the options is either to take out some money, like withdraw some cash, or to take out money to buy additional coverage. That is to increase the coverage. So all those options will be presented to the client, and the client will decide which options to go with. So that is exempt test increase principles that we talked about yesterday. We also talked about anti-dumping rules. All right, so this anti-dumping rules is strategies that is being put in place, to prevent people from taking advantage of universal life insurance policies to grow money tax-free. You see, anywhere there's money, CRA will not remove their eyes. You see, so apparently, before all these things are being put in place, it means that they have historical records. Like when we get to ACB now, we'll see, like before, December 1st of 1982, people were just having fun, putting any amount they want in their policy, and they were just, cashing out. Then the scale fell off CRA's eyes, and by December 2nd of 1982, bam, they introduced these principles to reduce ACP. All right? So now, same thing with anti-dumping rules. The anti-dumping rules utilize what we call the 250% strategies for every three years. But you just need to know what these principles are there to guide against, because in most cases, you are not going to be asked to start calculating all those kind of this thing, okay? But just for you to understand the principles. And lastly, yesterday we talked about the ACB. That was the baba that kept us on our toes for the most part of last night class. Before I do a quick recap on the ACB strategies that we did yesterday, let me take one or two questions so that as I'm doing the recap, I'll know the direction to do the summary. So I want to take just two questions regarding ACB so that I know where your gaps are. So please don't unmute yourself until you're ready to talk, and raise your digital hand. I'm going to take just two people. Raise your digital hand if you have a question, and I'll call you. And it's only concerning ACB. And if you understand it perfectly well, let me know in the chat so that I don't even need to waste time, recapping ACB. Then we move on to corporate, wherever that we are starting on tonight. So since no hand is up, I want to conclude that ACB is a done deal for us. Then we're good, right? Okay. Wow. So it means I did a fantastic job yesterday. Thank you. I'm so glad I asked this. So tonight we're moving on to business life insurance. Okay. So, you're thinking, I want to high net worth clients, I want to be able to do policies for business owners. Come forward. Sit on the first row. Okay. Did I get your attention? Of course, all of us want to be able to do, insurance policies for doctors, for lawyers, for contractors, for business owners. So this is where we are talking about right now, okay? Now, business life insurance, in part, just like, everything we'll be learning from chapter 1 to chapter 7, that is on individual life. So now we are going to see that same thing on a corporation, right? Now, if a business owner does not have insurance and something happened to that business owner, what is the impact of death of a business owner on the business? Number one, there's going to be loss of skills. Okay, I learned about this whiteboard. It's been there on share whiteboard. It's been there on on what's it called, on Zoom. So I want to to try using it. Wait, whiteboard. I saw it just now. Where is it? Okay, whiteboard. New whiteboard. Oh, interesting. Fancy. All right. Do I need to share it to? Sharing your screen will close the whiteboard. Oh, can you guys see my whiteboard?
Yes, we can see.
Yes, can see it.
Ah, interesting. Okay, I put it to keyboard. Okay, I'm learning. All right. So, number one is that the impact of the passing of a business owner is, number one, loss of skills. You can't even imagine, right? So a chef of a restaurant dies, business can arrange a key person insurance to that effect, right? So when a chef, somebody that owns a restaurant and that person is the chef, so if the person passes away, that skill is lost, right? Aha. So, hello, can you please share the WhatsApp link? Thank you. Okay, the link to join the WhatsApp group. Okay, Violet or Unique, can you help me share that link in the chat, please? Okay. Unique, I'm going to also make you my co-host. Yes. I'll making you my co-host as well, so that you can help me out if I need anything. Okay. All right. So as I was saying, the loss of skill, and what that is a situation right there. And what solution can we put in place to address that concern is to put in place a key person life insurance, okay? Now, creditors demand, business take loans, and it's a requirement for the loan security to take out life insurance, all right? So as a business owner, when you want to take a loan, you go to the bank, right? The bank always demand that that key person, that business should take a loan, a policy, all right, from iPhone, okay, a policy, so that in case anything happens to the owner of the business, at least there will be an insurance coverage that will pay the bank. Okay, so that is creditors' demand. All right, so business life insurance is needed in, number one, situation where that can lead to loss of skill, that is the owner of the business dying. Number two, situation where the business is looking to secure a loan from the bank will require the business to take a life insurance, to have insurance in place. Now, family members interference, that is, if a business has multiple owners. 1 second, please. I talk to you. No, you can't talk to me. Now, leave. No, not now. I understand. I'll talk to you later. Sorry about that. Okay. So family interference. If business has multiple owners, one dies, then the spouse of children may be incapable of running the business. So a buy and sell agreement will help to address this. All right. You can imagine a business that maybe they have 3 owners, okay, and then one of them passes away. And the one that passes away, maybe the wife, the spouse is not interested in the business. So it will be chaotic. So the other people, their family, so like there's an easy way to address this situation right out the gate, even before anybody passes away, is to take what? There's what we call here buy-sell agreement. Okay, that will help address that situation. And then equal for family members. See, taking a business life insurance helps to balance like distribution of assets among family members. For example, if somebody owns a farm, if a farmer owns a farm, right? And then this farmer have 2 children, okay? One of the children is interested in farming, and that one is vitally involved in the farming activities. And then the other one is not interested, he's into tech, and that is his thing, right? So for this parent to have equal distribution for his children, he could take a business insurance such that the one that is interested in the farming can take the farm 100%. then the one that is not interested in the farm can now take the business, the life insurance policy will now be used to settle the one that is not interested in the farming activities. All right. So that is a way a business life insurance can be used to solve the problem that arises when it comes to asset distribution amongst beneficiaries. And then the next one is capital gain tax. Okay. Upon the passing of a business owner, there's going to be an emergence of capital gain. That is for a fact. And how would they navigate through this? And this capital gain task can be a whole lot to deal with. So having a business life insurance in place will enable, the family to receive the death benefit and then utilize that to pay off any capital gain tax that would have emerged as a result of the death of the business owner. So right out the gate, we've addressed 5 situations that we can take advantage of business life insurance to resolve or to solve rather. Okay? Awesome. I hope you're taking your note. Do you have your note? You're making your note? Yes, yes, yes. I think I'll just remove this whiteboard for now. I'm trying to explore new things. Anyways, so we are moving on to different types of businesses. We have the sole proprietor, we have partnership, and then we have corporations. So these are elementary. I don't think I should go into explaining to you guys what is sole proprietor, what is partnership, and then what is corporations. If you guys want me to quickly explain it, say yes, yes in the chat. There are 11 of you in the class, so I need to see 11 yes. Let's make it fast. If you want me to explain, say yes. If not, say no. Quick, 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 quick. I have my co-hosts. They are checking for me how many yeses and how many no's we get. Okay? Okay. All right. So we're moving on. We are moving on. Thank you. You guys got the hand on this. Fantastic. All right. So we are moving on to capital gains exemption for CCPC. Okay. Capital gain exemption. All right. What is capital gain exemption? The CCPC shares may be eligible for tax exemptions. Okay. So, somebody say yes. Blessing. So, okay, co-host, how many years do we have? How many no's? Where are my co-hosts now?
We have 6 no and
1 yes.
Okay, so the no got it. Sorry. So if you need that explanation, let me know at the end of the class and then we'll see what we can do. But for now, we are moving on. All right. So the shares. Okay. So what this is that every Canadian company have what we call the lifetime capital gain exemption. Lifetime capital gain exemption. I think it used to be up to 800,000 index for inflation. All right. So it means that capital gain exemption, if you're a Canadian owned company and your corporation is valued, let's say 1 million, or you sell your company, you sell it for 1 million, you're not going to pay any taxes. You're not going to pay taxes on 800,000. You just pay taxes on the delta. So that's what we call the lifetime capital gain exemption. That's just one time opportunity. Okay. And this can also be used for family farms or family fishing business. It could be a farm, it could be fishing business, whatever it is that is a Canadian owned company, you are entitled to that. I think this number changed very recently. It was increased very recently. Can somebody Google lifetime capital gain exemption 2024 and let me know what number you get there? Okay. All right. So there would be calculations around that. Okay. For example, I have example here. Jane was a sole shareholder of his sportswear manufacturing company, Kiliman, which is a CCPC when he died. So the CCPC stands for the that is what is it called again? CCPC. Somebody Google.
Hello, my 1.125 million.
Okay, it's now 1.125 million. Okay, note that down. Okay, so when he died, the business had a fair market value of 2.4 million and has adjusted cost basis of 200,000. He left the business to his daughter, Yvonne. So this deemed disposition resulted in a capital gain of 2.2 million. Okay, so how did they arrive at 2.2 million? They removed the 2.4 minus 200,000, that's 2.2. All right, now the capital gain is 2.4 minus this, which is 2.2. However, because Jean has never made use of his LCGE, so 8 something, but in this 2.2 million now, based on the new amount, that amount will be deducted from the capital gain, and the difference is what the person will pay taxes on. Okay, there's Canadian Controlled Private Corporations. Thank you very much. CCPC, Canadian Controlled Private Corporations. CCPC. Okay, so then again, you see this ACB keep coming up. ACB is the total expenses over time on that corporations. All right, so that is a very straightforward concept and principle. Ene, yes, yes, yes. Be putting your yes in the chat box as we are moving forward. All right, so that you get involved. Don't say yes or no. If you say no, we know that, okay, there's something that we need to explain. But when you say yes, we have 2 co-hosts, Yannick and Violet. They are watching it. They'll let us know that, oh, do a quick recap. Somebody needs something. All right, we are moving on to key person insurance. Okay, a company pays the premium, company receives the death benefit for that purpose. All right, so again, now we have key person insurance. We talked about it earlier, right? A key person insurance is you are the owner of the business, you are the face of the business, you need to protect yourself, because if anything happens to you, the business is going to take a hit, a big blow, right? And we saw an example of a chef that owns a restaurant. If anything happens to that chef, there are so many customers that are coming to that restaurant because of, the special dishes that the chef prepares, right? So it's very important for the chef to have a key person insurance, so that if anything happens to the chef, that death benefit can be used to hire a new and highly qualified chef, okay? By recruiting and training a replacement for the person, by making up for the lost revenue, or by covering overhead expenses. Because take it or leave it, you see, when something happens to the face of the business will take a big blow. There are some customers that will be lost forever, and the business may or may not even recover. However, there are overheads, okay, that are not going anywhere. There's what we call fixed cost and variable cost, right? The fixed cost, whether the business open or not, is going to keep running, right? So all these things helps to address that, okay? And also split dollar arrangement, okay? And like I talked about situation where if somebody were to, okay, no, that is not the distinct, but split dollar arrangement, common type of split dollar arrangement, company pays cost of insurance. Okay, so now in a situation whereby the corporation takes a key person insurance, the corporation pays the insurance premium, the death benefit will be paid to the corporations. I've had people ask me all the time, okay, Joy, I own my own business, so can I take a policy on myself? Yes. However, if your business is paying for the premium, the death benefit will be paid to the business. So company pays the premium, company receives the death benefit for that purpose. Okay? Awesome. Now, if it is a split premium, okay, I see your hand, Ayo. Give me a second. Let me just finish. If it's a split premium, if company pays half and then the key person pays half, then what happens in that case? The employee pays investment portion of the premium. The family receives the investment value. Okay, if it's a split situation where the company pays the cost of insurance, and then the key person pays the investment component. So in that situation, the company receives the death benefits, then the beneficiary of the key person receives the investment component. All right? Then there's what we call uncommon type of split dollar. Employee pays cost of insurance portion of the premium and family gets the benefit tax-free. Okay, company pays investment. That's just the reverse. Okay. Again, in a situation whereby the company pays the investment amount and then the key person pays the cost of pure insurance, then the reverse is the case. The investment goes to the company and then the what's it called? The death benefit goes to the key person's beneficiary. Yes, Ayo, I'm ready to take your question.
Yeah, is the same thing applicable to sole proprietors and a partnership? That when the owner of the company, as the sole proprietor, if he dies, the death benefit will be paid to the company.
That's if the policy is owned and premium paid by the company, yes. Now, when it's a partnership where you have 2 or 3 people, then that needs to be structured properly in your partnership, okay, so that you don't have situation whereby somebody will unalive another person because of death benefit payout, right? So again, in the case of partnership, that will be structured. If the company pays the premium, the death benefit will be paid to the company. Okay. Whether it's partnership or corporation or sole proprietor.
All right. Yeah, thank you.
You're welcome, sir. All right. So there's also what we call the crisscross insurance. Okay. What is crisscross insurance? Now, when you hear crisscross, this is the way I always tell my students, cross your hand like this, okay? This one pointing to the, just when you hear crisscross, immediately do your hand like this. What does that mean? You have 2 people. It means that there are 2 of us. I will take policy on my partner and my partner will take policy on myself. That is crisscross. Okay? So, example, Jack, okay, and Alfred each own 50% of the 200 shares of Jack Incorporated, a frozen dessert company. They implemented.
We cannot hear you. You are now on mute.
Muted me, co-host. You guys muted me. I did not mute myself. Somebody muted me. Please don't mute me, please.
I'm trying to mute Elizabeth. I was trying to mute Elizabeth. Sorry.
It's all right. Okay. So I'll crisscross some insurance. Like I said, you cross your hand like this. These are 2 people. One hand is pointing to the other person. The other hand is pointing to the other person. In other words, 2 of you are partners in the business, but you are taking policy on each other's life. Okay, and then listen carefully for this example. Jack and Alfred each own 50% of the 200 shares of Jackal Incorporated, a frozen dessert company. They implemented a buy-sell agreement funded with crisscross insurance. Jack died shortly thereafter. The overall process will look like this. Okay, so this is Jack. Okay, Jack. And then there's insurance company. All right. Now, there's what we call CDA account. That is, I think it's corporate dividend account. That's what it's called. Is it corporate dividend account? I think so. So that's just let me know. Oh, okay. Okay. So hold on, guys. I'm just trying to see. Okay, so Jack and Alfred pays the premium for life insurance of each other. When Jack dies and the 100th of his shares is transferred to the estate, okay, and then the insurance company pays the tax-free death benefit to Alfred. Then Alfred paid Jack's estate for the 100 shares. And then Jack's estate transferred the 100 shares to Alfred, who now owns all the 200 shares. Do you guys understand? So they take life insurance on each other, okay? However, the other person passes away shortly after they've taken that policy. All right? So what is going to happen is that the person that passes away, his own 100 shares will be transferred into the estate of the business, but death benefit will be paid to the surviving partner. Remember, they took crisscross on each other, and that's why when we are doing crisscross, you have to be sure who you are doing crisscross arrangement with. Because the last man standing, in my own opinion, seems to have it all. That's in my own opinion. All right? Because when the other person passes away, the death benefit is paid to the surviving, which he now use that cash to pay the beneficiary of the deceased partner, and then acquire the 100 shares that was owned by the deceased partner. Now his own shares now become 200 shares. Now he now owns the entire company, basically. Is that clear? So that's crisscross arrangement right there. Okay. Yes, Ion.
Well, is it part of the regulation, or should the bereaved family refuse to collect that overture, and they want to maintain that 100%?
Yeah. So that is not regulation. It's optional, right? And that is what they can do before the owner, their family person that co-own the company passes away. So if they are not happy with that arrangement, then instead of taking a crisscross, then they might as well take a personal life insurance and pay for it themselves and have enough money, okay? Because when that person passes away, it will trigger capital gain tax for sure, right? So if they do have a personal life insurance on the person, then they'll use the death benefit they will receive, because in that case, the death benefit will be paid to them directly. Then they can use that to offset whatever capital gain tax emerges, and then they get to keep the shares in the family and continue to have control of the company with the other partner.
Okay, so but once it's crisscross, that how that the day will carry the day. That the death benefit will be paid to the surviving person, and the surviving person will use that money to offset the bereaved family.
That's correct.
Okay, thank you.
Okay, all right. So now the next type of business life insurance that we are going to be looking at is the one we call buy-sell agreement. Okay, now it's kind of, it's not crisscross, but the way buy-sell agreement is that the owner agrees to buy interest of the deceased owner's shares and transfer to other directors. So numbers of shares stays the same. All right. So in other words, the buy share agreement is that they have the policy, and then they agree that if any partner that passes away, that death benefit will be used to buy the shares of the deceased. Okay, so what that does is that it helps ensure that the share stays within the company, so they don't need to go and source for buyers from outside. Okay, and that's what helped them. And also that also helped them to have a guaranteed sales value in place, because the sales price will be determined from the beginning, not at the point that the person passes away. Okay, so that is buy and sell agreement right there for us. Okay, now we've talked about crisscross purchase arrangement and how that works. And then capital dividend account. Yes, that's a CDA account. So you've been hearing me talk about CDA. That stands for capital dividend account. Okay, this is an account, a corporation account. All right. So anytime that there is death benefit, it is paid into that CDA account. And then from that CDA account, it can then be disbursed to do other things. So here, a private corporation uses its capital dividend account to record various amounts that is received on a tax-free basis. Okay, and we all know that death benefit is received tax-free. All right, and these are the strategies that makes us to be able to do corporate insurance for doctors, right? You'll be able to do it for them, because most doctors, the business is there as 100%, or maybe their wife or their children. So the business is in the family. If they are still sure of who their partners in the business is, this shouldn't be a problem, because even whether it's paid to CDA account, is the same owners. That is it. So why not? Right? So that is my own 2 cents on that anyways. Okay. Now, applications and underwriting of insurance policy. So far, how are we doing so far? Yes. Any no? Because we are moving on into a sweet spot. This area now, we are going to fly through it. And by God's grace, we'll be able to take some questions before we leave tonight. All right, my co-host, how many yes, how many no's? Yes. I'm using this to figure out how many people are sleeping on us right now. So if you are awake and the class is clear so far, put yes in the chat.
There is no yes,
Okay?
no.
Okay, so we are not moving forward until we see yes. So I want to see either 12 yes or no, and then we know who says no. We find out which area do you need me to go over, so that everybody is on the same page. Okay?
4 yes.
Okay, so we need more yes. We need more yes. 12 of us on the call tonight. Wow, that's good. That's good. So you guys are good students. You're getting it. Woo, give yourself a round of applause. Fantastic. I'm glad to hear that. All right. So we are moving on to another fun part. Another fun part is application and underwriting. We all know that, you see, insurance policy is not even like started without an application. Anyway, it started with illustrations. And when we've done illustration, the next thing is application. Let me show you guys how application looks like with one of our partners, okay? So I'm going to, again, you always, see me referencing Beneva, because they are our sponsors. Once you guys get your license, right, you're going to get sponsored by Beneva. Okay, so this is our Beneva software. And the cool thing is that this is insurance application paperwork. Guys, I want to use the paperwork. Assuming I'm doing this, or I'm completing an application for my client, I typically use the electronics. That one is real time. boom, 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 done. But because for the sake of the class tonight, I'll be showing you guys the paper application. Is it loading? Permanent insurance. Okay, so I'm not sure if it's loading here. Give me 1 sec. I'm just going to launch it again. Here. Okay. So wow, this is interesting. Anyways, let me just share my screen. All right. So this is application and underwriting. So typically, like I showed you guys the other day, illustrations, right? In chapter 1, we unpack, a lot of illustration. So this is how individual life insurance policy application looks like. How many pages? 36 pages. But don't freak out because we don't get to complete the entire 36 pages. You just completed the necessary section, and that will be it. Okay. Now, these are the application paperwork. And as we go through application and underwriting, then I'll just come here and show you guys this is what they're talking about. But when you hear application, you can see it has basic information, name, date of birth, Canadian status, arrival date, and stuff like that, address, and then it tells you about occupation, employment details, who do you work for, and stuff like that, right? Who is the owner of this policy? Policy owner, life insured, if it's different from policy owner. Okay. Yeah, see that's what we have there. And also, if policy owner is a corporation, you see, we just talked about corporate insurance, right? So if I'm doing this for a doctor or if this is owned by a business, I'm going to be completing this section, okay? Because the business will be the policy owner. All right, guys? Awesome. So, yeah, that is on that one. Then third-party identification, if applicable, all right? And then a proposed life insured, that is beneficiaries. We talked about beneficiaries a couple of days ago. Then you have opportunity to name your beneficiary, contingent beneficiaries. What is contingent beneficiary? Beneficiary is your main beneficiary, the one that will receive the death benefit once anything happens to the life insured. The contingent beneficiary is there as a backup situation whereby maybe the beneficiary, something happens to the beneficiary, or the beneficiary passes away before the life insured, then the contingent beneficiary becomes the main beneficiary. All right. Okay. So yeah, then we have what we call, if it's for whole life, we complete this. Any question?
Someone said that they are not able to see your screen, but I can see it.
Oh,
Yes, I can see it, but if
okay.
I think the person should
Blue.
refresh the screen.
Okay, let me share it again. Okay. Is it okay now? Is it better for the person? Anyways.
So we
Okay.
can see, I can see it. I can see it. So.
All right. Okay, so because of the way the application paperwork is structured, right? So you have sections for whole life, okay? And then you have section for term insurance. So if you are doing term 20, you're going to complete this section for the client. If the client is doing term for 10 years, you complete this section. So all these are information that you're going to complete during the application process. Now, I want us to know that as we, the financial advisors, are completing the application, right? this is the beginning of underwriting process, right? Because we are representing the insurance company, okay? And that is why we need to make sure that we are collecting and documenting accurate information, because this is part of underwriting process. There are situations whereby the underwriter just take the application, they review it, they approve the policy right out the gate. Why? Because the insurance company believes us. We are on their side as well as on client side. We are on both sides. So we do right by the client and also present the correct and accurate information to the insurance company. Okay, so this application paperwork is part of underwriting process. In fact, we conduct the initial underwriting with the client even before the insurance company by going through all these questionnaires with the client. If the client wants to do disability insurance, this is the section we complete to that effect. Okay, of course, critical illness, if there's a critical illness layered in this policy, we complete here. Now, all these sections are there. We don't have to complete them if the client is not taking any of these add-ons, okay? And of course, for universal life, we complete this section, all right? Kidoki, and of course, in universal life, like I did mention before, we work with the client to select the investment portfolios. So whatever investment portfolios we select for the client, we come here, for example, if we pick Hillsdale's, 50%, we put it there because at the end of the day, if we pick 4 investment, the 4 investment have to aggregate to 100%. Okay, we can pick one and assign 100%. We can pick 4, 25, 25, 25, or we can mix and match. But at the end of the day, it must aggregate 100%. All right. So if we are doing a rider for children, this is where we complete that details here. And then from there, we move on to medical underwriting questionnaire. So that's when we start asking questions. But this is a key concept I want to share with us. It's called Temporary Insurance Agreement. It stands for TIA. Okay, so this Temporary Insurance Agreement, right, provide the life insured coverage right from the moment we complete the application. Even before we send it to the insurance company, their coverage kicks in. And this is an exam question, so you guys pay attention. How is that possible? So long as the person answers no to all these questions, and they agreed that the insurance company can take their premium immediately, they have what we call temporary insurance agreement in place. So if the person complete the application with me tonight, and the person drive out and God forbid something happened to that person, insurance company will pay. Yes. Okay. However, if they answer yes to any of these questions, then they will not be eligible for temporary insurance agreement. And if they say that, oh, they don't want insurance company to take withdraw premium until the approval, then they will not be eligible for that as well. Okay, so yeah, so that is that on the information. Of course, we collect health information. We ask them, make sure you ask all these health related questions. Yes, some of them might sound so funny, so wonky, so but still go over it one by one with the client, okay? Yeah. So yeah, that is that. Then of course, collect the banking information, signature, and of course, we the advisors, we have our own sections that we complete. This is the banking information that we get. This is for the advisor. This is for the advisors to complete 1 or 2 more signatures, and then we are done. Okay. Now, how about in a situation where there's incomplete or erroneous information? Well, a mistake can be a material misrepresentation, which will affect underwriting, or immaterial first 2 years of the policy. Okay, so now if there are what we call material, misrepresentation and immaterial misrepresentation. Remember when we talked about what is it called? Contestability period, right? So if there's the insurance company have 2 years, okay, if the information is not a serious situation and is not motivated with the intent to mislead the insurance company, then after 2 years, insurance company cannot do anything. However, if the information, the misrepresentation in the application is a fundamental misrepresentation and is proven that is motivated with intent, okay, to mislead the insurance company, that is fraud, even though it's past contestability period, that policy can still be cancelled, terminated by the insurance company. All right? All right, so I've explained our temporary insurance agreement, all right? And underwriting request of information. Now, there are information that the underwriters typically ask for once we've submitted the application. One of them is attending physician statement. Okay, that stands for past medical history. Okay, all of us have a medical history, just like we have, our financial standing data with credit bureau, right? So if they want to check our credit, if we are looking to borrow money, they check our credit. Same way, we have a medical data that is open for insurance company to access, and that's for our APS or MBI. You see MBI? Yeah. APS, attending physician statement, okay? And then medical exams, current medical status. So insurance company can send a nurse to your house to conduct those medical exams, like, they'll take your blood, your urine, your ECG, current health status. They'll do all that. They are not going to charge you for doing all that, though. And that is just to enable them to determine, your health status at the time of this thing. Yes, the word I was looking for is MIB, Medical Information Bureau. Okay, insurance company can also check your medical information bureau to see, your past medical history. All right. Okay, so that is that when it comes to underwriting, and then when it comes to information that insurance company can look into to determine, their decision in approving your policy. Okay. How about people who are not Canadian citizens? Well, PR are eligible for life insurance, okay? And then also people that are waiting PR may also be eligible. International students, okay, that have work permits are also eligible to a certain amount, all right? I think they're eligible up to 500,000, okay? All right, so risk cases. When we talk about risk cases, we're talking about the risk that the insurance company is taking in providing insurance coverage, okay, for an individual. There's what we call normal risk, there's preferred risk, and there's rated, and of course, exclusion or decline. So those are the 5 possible outcomes of a life insurance application, okay? Standard, a policy can be approved standard, that is, this person is normal, healthy, yeah. So that is standard. Once somebody is approved standard, okay, hallelujah, good, good, good. Now, the next category of people is people that are approved preferred. So people that are approved as preferred is, they are not standard, okay? However, they are not high risk. So they're somewhere in the middle there. So they're basically low risk. So their premium is slightly higher than that of someone that is being approved standard. You got it? All right. So the next possible outcome of life insurance application is rated situation. So these people, they are not, denied. However, they are termed to be high risk. Okay. So their premium is rated. Example of such people are smokers. Okay. Smokers will be approved that they pay higher than someone that is approved standard. And number 4 is excluded situation. Excluded situation is situation where somebody is approved, but if with some conditions. For example, if somebody visits, there are some certain countries, okay, that is on insurance radar. So if somebody visits that country frequently, so insurance company will approve that person, but they will exclude the place, okay, that person go. For example, let me say Afghanistan, for example, okay. So if somebody normally visit Afghanistan, insurance company may approve the person, but they will exclude Afghanistan from the policy. In other words, if anything happens to the person in Afghanistan, the insurance policy will not be paid out. Okay? And of course, the final one is declined. So this one, the insurance company say, no, nothing we're gonna do about this. We can't show you. And of course we've had instances like that. But the beautiful thing about us in Experior is that because we have several partners, even when insurance companies say no to somebody, we have other companies to take them to, like CPP. CPP never say never to anybody, just that the person might pay slightly higher, but the person will get coverage. All right. All right, so let's look at company factors that may affect, life insurance premium. Number 1 is mortality cost. Number 2 is admin cost. And number 3 is investment returns, okay? So, of course, mortality cost is the rate of dying, okay? So that, all right, affects the cost of premium. Let me stop sharing so I can be seeing everybody. All right. And then the second factors that affect premium is admin cost and expenses. Of course, like we discussed, was it yesterday or 2 days ago? Insurance company undergo several expenses, in rolling out insurance policies. One of the expenses they incur is, of course, paying us the insurance broker. Our commission is part of the expenses that the insurance company incurs. And of course, they also have other admin related expenses as well, and investment returns. Okay, so yeah, those are the factors that affect premiums. All right, delivery of policy. So delivery of policy must be done face to face, and that was before pandemic. All right, but now policy is not delivered face to face. Okay, but I don't know if the current model of delivery of policy is implemented into their questions yet, because before, the way policies were delivered is that the insurance company will mail out the policies to us, the advisors, and then we, the advisors, will now take it to the policy owner and will deliver it face to face. But since the pandemic, what insurance company does now is that they send the hard copy policy to the policy owner address, and then they send us the soft copy, and then we just do the policy delivery over Zoom with the client, because almost everything we do now is on Zoom, right? And what do we do during the policy delivery, right? We review the policy and the features of the policy with the policy owner. We confirm that the health and financial aspect of the policy owner is still the same since we completed the applications. In other words, that nothing have changed. All right. We also confirm that the clients have not had any material change in their health, in their finances, right? If there's any change at all, we had to document that, okay? And then, of course, client needs to sign and date the day that the delivery of the policy was made, okay? And then from that date, the client have what we called 10-day free look period. In other words, from the day of the client signed the delivery document, the client have 10 days to change their mind. After 10 days, it means they are keeping the policy. All right? Okay, so how does underwriting looks like when it comes to corporate insurance? Sorry, when it comes to group insurance. You see, group insurance, you guys recall we tackled group insurance on Monday, right? So group insurance is underwriting is pretty much straightforward because basic group insurance, all employees are covered, no medical, okay? However, if an employee wants to take additional coverage, then premium will be based on their age and their status on that, whatever difference they are taking at that point. Otherwise, whatever base coverage is provided to the employee that is in the group, that is automatic coverage, okay? All right. Okay, needs analysis. Chapter 10. Oops. What happened? Sorry, guys. I think I kicked my extension cord here and my light went off. There we go. All right. So needs analysis. Well, needs analysis is how we determine the needs of an individual or of a family. Okay. So we do that by, looking at the number of dependents that they have, the children, do they have any other spousal support, other things? And for us in Experior, let me share with you guys the way we conduct, let me see here. Our needs analysis in Experior let me switch to Canadian. Login. So I'm not sure if I showed you guys the other day, all right? Remind me later. So we have a whole tab here in our virtual office that talks about EFA, right? So let's look at the EFA lines, right? So with this now, we're able to do a quick needs analysis. For example, we put, the person's name, what is their age? Let's say they are 35. Life expectancy for the most part is 82 for men. We leave that there. Now, anyone you don't understand, just hover over your cursor like this. It tells you, okay, total client owes in terms of mortgage or any outstanding balance or whatever. Let's say they are owing 500,000, okay? And what is their monthly expenses? Let's say their monthly expenses is 5,000. And then what is income? Let's say 100,000. Do they want to do any income replacement? Maybe no. And then do they have any case and they're putting money aside for the education? Let's say 0 for now. Okay. So we calculate. Percentage of annual income cannot be, let's see. Percentage of clients' annual income that they want to be replaced. Okay, 100%. All right. Okay. So based on this quick exercise I've done here, so the needs analysis for this client is 510,000. Okay, so it varies. So for us, like this needs analysis thing is not something that you crack your brain for, but for the sake of this exam, just understand what is needs analysis. Needs analysis is just you understanding the needs of your client, that you are not just, forcing any solution down their throat, but you are putting all their situation and circumstances into consideration to arrive at what you feel their needs may look like, okay? And what are those things you put into consideration? You put, like we see, like here in this, our EFA, as you can see. We put into consideration the client's employment status, okay? Is he an employee? Is the client a business owner? Is he retired? Or how much time does he have to retirement? All right? What will be the retirement income in terms of CPP, OAS, and all those other stuff? Okay? And then
I
we
have a
also need,
question.
yeah?
Where are you going to see the CPP amount?
No, we will have to ask the client. So this is like information gathering process, right? We're going to ask the client, like, okay, how much time do you have to retirement? And then they will know, like, okay, if they're approaching retirement, or if they are in their active work, how much are they currently contributing into their RRSP? Because if you use the full EFA full version, so this will enable you to track much details. For example, let me just use this. Okay, so I can hit next. Date of birth. Oh my gosh. Okay, let me just 1979, whatever date is that, just to show you guys. Okay, so if we are doing the EFA full version, you see these are the detailed information gathering process you go through. You go through their mortgage, first of all, capture their personal information, then go through their mortgage. Are they renting? Do they own their home? How much mortgage do they owe and all stuff? Then you move on to savings and retirement. Okay, how much are they contributing into their retirement plan? If they have any, and then go to education. Do they owe any money? Student loan? Are they saving for their kids' education? Do they have life insurance? What is their overall financial situation? What is their goal? What is their net worth? So by the time you finish this, you're going to have a holistic report that tells you that, okay, based on what they are doing so far, this is what retirement life would look like for them. And be able to, oh, sorry. So I'm not even sharing this, and you guys didn't tell me. So this is what the tab I was just mentioning, okay?
Okay.
And this is, yeah, and this is how we go through each of these tabs. And then by the time you're done, this is how you determine and assess their current financial situation and be able to determine, their and propose the right solution, okay, that is suitable for them. All right? Okay. So we move on to identifying client priorities in terms of debt. You see, in the same way as we are gathering the information to determine their needs analysis, we also ask them what is the priority for them, okay? Was it their family lifestyle? Is it the childcare? Or is it the family residence where they are currently living? You see, we ask lots and lots of questions, and from the response we get, that will enable us to put the right plan in place. Okay. Now, once we have done all this, that's when we now recommend insurance policy. Okay, based on the following: based on the probability of death, and it will be based on their age, based on their gender, based on their lifestyle, financial impact, and all those kind of stuff. And also what their goals are too. Because some people, if their goal may be to give to the charity of their choice, right? So our goal is to make sure that whatever their own goals are is met for them. All right? Okay. How are we doing so far? Say yes, 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 or no, no, no.
Yes, yes, yes.
All right. Wonderful. Okay. So let's approach case study, other obligations, limited time. Okay. And anyways, every other this thing here is just ongoing service, okay? And you see, when we do this needs analysis and we provide these solutions, okay, the good thing, and that's one thing I love about Experior, all right? So when we capture this needs analysis, it's a living, breathing document. For example, when I come here and I click on EFA completed, right? See, if I click here, it takes me to all my previous, oh my God, all the previous EFAs that I've done for my clients, right? So whenever I am doing a follow-up, it may be 6 months follow-up, it may be 1 year review, portfolio review with my client. So all I just do is open this EFA and then I go over it with them. Has anything changed? Right? Has anything changed? Is there things we need to include? Because if this document becomes a living, breathing document that we can continuously update to reflect our clients' current situations. So that is that. And with that, we have finished highlighting some of the key principles we were scheduled to look into for life insurance. All right. So I want us to take a quick 5 minutes break, and then we come back to go over 150 questions. Okay. Any questions so far before we take 5 minutes water break? Or should we continue plying through? You guys talk to me.
We can take 5 minutes.
I try to ask a question.
Yes, go ahead, Mercy.
You mentioned rate of return. I was thinking rate of return is about the client, but you said is what we get paid.
Okay.
When you bring in a client and close a business, you get paid. I'm like, oh, I got that wrong. I was thinking is about the client. When the client starts, the benefit we get when we bring in a client. Oh, what am I saying? I'm mixing it up now. I did not really understand that rate of return. Is it one-time rate of return or ongoing when you bring in a client?
Okay, so I just want to clarify what your actual question is, because are you talking about the commission we get paid as insurance agent, or the rate of returns that the client gets from their investment?
That was my understanding. The one client gets from investment, but when you mention we get paid, I'm kind of thinking, so what is the actual rate of return? Is it about the client or about us?
Okay, I can't remember the conversation that led to that and other which, but if I can kind of explain. So we get paid commission, okay? Once the deal is done, submitted and approved, we get paid commission. And our commission has nothing to do with the rate of returns on the investment of the client, okay? So when we go through the investment portfolio with the clients, it's just so we can, okay, so let me, typically I typically don't do this, so but let me pull that up. Let me see. Okay, I need to log into Beneva. Give me one quick sec. Beneva here. Okay. And I need to log in here. Am I TiVo? Oh, okay. So this is Beneva software, the UL rate of returns. All right. So I just want to, this is for Universal Life. Okay. And
Mommy, are you done your meeting yet?
I'm not done yet. Okay.
It's taking for a long time.
I know.
It's not going to end.
Okay. So I just brought that up. Now let me project that for you to see. Okay. So now if this is with Beneva, right? If we are doing industrial alliance, then we will go pick the rate of returns for industrial alliance. Okay. So now when we are picking investment for a client for Beneva, you see, these are investments, and these are the historical records going back 10 years. Okay, so this is the rate of returns I'm talking about. So based on the client risk tolerance, okay, because some clients, they are conservative investors, so we don't put them so much into aggressive. So we do their risk profile and do their investor profile before we go into this. Now, let's say, like you see this investment here, this one, 10 years return. This is US technology. This investment always deliver. You see, 10-year average is 23.33%, right? And this is 5 years, 3 years, 2 years, 1 year. Year to date, this 2024, as we are talking, this policy have delivered 20-something%. So this is what we show client. And many times the client will be like, what? You mean there's a place one can get this kind of return? I felt so too. I never knew there is an investment like this existing. You see? When they say like that, oh my goodness, 7, 9, 3, 6, 10. There's something for everybody. So this is the rate of returns I'm talking about. And then when it comes to our own commission, of course, all of you here know how we get paid in Experior, right? Okay, so I hope that helps.
It helps. I was asking, is it one-time payment for us? Is it one-time payment?
Okay, so this class is not to discuss Experior commission model, right? Okay. Which hierarchy are you?
I'm coming.
Okay, yeah, so your ED will go over compensation with you, because if we go into that, it's a layer of information I'll have to start unpacking, because I'll have to start, teaching commissions, override generations. We don't have that time in this class, okay? If you need help, you let me know at another time, okay? All right. Okay. Water break. Right now, water break is down to only 3 minutes. So we start in 3 minutes, okay, guys? Thank you. Okay. All right, let me start sharing.
Sorry, quick one.
Yeah?
I noticed that it's not like you're necessarily going through all the topics in the text. So it's expected for us to read the entire text, right?
Yeah, so that is the strategy I'm going to share with you guys at the end of this class. Okay.
Thank you very much.
So Violet, please remind me, okay? All right, let's go. What kind of life insurance beneficiary requires his or her consent when a change of beneficiary is made? Irrevocable beneficiary, tertiary beneficiary, primary beneficiary, or revocable beneficiary? Which one is it?
Irrevocable beneficiary.
What kind of life? Yes.
No, it's
let's see.
revocable.
Yes, correct. Who is that? Say your name now.
Oh, irrevocable, yes.
You got it.
Elizabeth.
Awesome. Good job. We're going to be moving very fast, guys. When can a policy owner change a revocable beneficiary? Anytime. After the consent of the current beneficiary. Never. Only if primary beneficiary dies. So what is
Anytime.
Yes, that's correct. Who is that?
Elizabeth.
Good job. Good job. Good job. Good job. Good job. Good job. You see, this is fun. This is fun. Let's go. Let's go. All right. Question number 3. Mr. M purchased accidental death and dismemberment policy and named his son as beneficiary. Mr. M has the right to change the beneficiary designation at any time. What type of beneficiary is
Revocable.
his son? Yeah! Good job, good job, good job, good job. All right, all right. How will a contingent beneficiary receive the policy proceed in an accidental death and dismemberment policy? Option A, if the primary beneficiary is a minor at the time of the insured's death. Option 2, if the primary beneficiary dies before the insured.
Oh, yeah.
Option 3, if the insured dies accidental causes. And option 4, if the insured dies of natural causes.
Option 2.
Okay, that is if the primary beneficiary dies before the insured.
Yes.
Yeah. Good job, good job. You see, guys, you see, it's not that deep, it's not that hard. You see, you guys are crushing me. Come on. Okay, which statement regarding the change of beneficiary provision is true? The beneficiary can only be changed with the consent of the insurer. Okay, so now this is the time you are looking for the right answer. So what this is telling you is that 3 of these 4 is wrong. You got it?
Yeah.
So the whole objective of this whole exercise, just so you know the dynamics of the way the test, the exam comes at you. All right. So now I say which statement regarding the change of beneficiary provision is true. So you are looking for the correct answer. Option 1, the beneficiary can only be changed with the consent of the insurer. The policy owner can change the beneficiary. The insured can change the beneficiary. A beneficiary change is subject to underwriting procedure.
The policy owner can change the
The
beneficiary.
policy owner.
The policy owner can change the beneficiary.
That's correct. That's correct. That's correct. Because the policy owner may change a beneficiary at any time. However, consent may be needed by the current beneficiary if it's designated as irrevocable. Awesome. Good job, guys. Okay, moving on to question number 6. A policy owner would like to change the beneficiary on a life insurance policy and make the change permanent. Which type of designation would fulfill this need? Revocable. Correct. So you guys understand, right? Is there anybody here? Because you see, like, and I love the pattern they are taking this. They take one topic, they are like, is there anybody here that is having difficulty understanding the principles, the concept of or everything that is being tested so far? Okay, we move. Okay, which statement is true regarding minor beneficiary? Normally, the death proceeds are required to be held in trust until the beneficiary reaches the age of 21. Normally, a guardian is required to be appointed in the beneficiary clause of the contract. The minor must pay the death of the insured estate before receiving the proceeds. The minor is entitled to receive the death proceeds immediately. Which one?
Option A.
Option A. Normally, normally the guardian is required to be appointed. So the option A is not. No.
When the minor is not of age. So
normally no, you say option A, that's not correct. So he said the correct answer is that normally a guardian is required to be appointed in the beneficiary clause of the contract. So look at what is the contract, the application paperwork. Let me show you guys where this is. Can you guys see the application?
Yes.
The
Okay. Yeah.
guardian can be the trust. Let me see here. We have, I don't know the number of page by heart, but I know we have it for children.
Try to Control F and write the.
Okay, let me see. Trust. Control F and then trust. Okay, see? Trustee for minor beneficiary, not applicable in Quebec. But if not in Quebec, you need to put the trustees if they are minors, okay? So that provision is here in the application. Okay, guys?
Yeah.
Okay. Okay, so moving on to question number 8. What is the underlying concept regarding level premium? Level premium builds cash value quicker in the early years.
No.
The early years are charged more than what is needed. The early years are charged less than what is needed. Level premiums can only be paid annually.
I think number C.
The early years are charged less
Is that
than
it?
what is.
They
The early years are charged more than what
are
is
charged
needed.
less.
Yeah. Level premium. Guys, so the level premium build cash value quicker in the early years. No, it
No.
doesn't. It doesn't. It doesn't. So it's going to be between the early years are charged more than what is known. The early years are charged less
I think it's C.
than what is C, right? Let's see. The early years are charged more than what is needed. Is that what C says?
No.
No, that's
No, that's B.
Number 2. Okay, say the early years are charged more. Is that it says? Does it say charge more?
Yes.
Yeah.
Okay,
That
say
is
the
second
early.
That is second option.
Yeah. Okay, the early are charged more than what is needed. The concept of level debt benefits. You guys remember we did that on Monday, right?
Oh, it was on Monday. Oh, okay.
The early years are charged because with level. Wait, hold on. What is the underlying concept regarding level premium? You see, level premium, you pay the same, okay? So in the early years, you are charged more than what is needed, yes. Well, and that's what it's saying. In the early years, you are charged, yes. This is correct, yeah. Okay, let's move on. Oh, did I sign in? Okay, guys, let me stop sharing. Let me sign in. Oh my God, this.
Oh, that is your password? Yeah, we can see it.
Am I still sharing?
I'm joking.
Oh. Okay, so we are back. Now, question 10. A policy owner is allowed to pay premium more than once a year under which provision? Insuring, consideration, payer, mode of premium. Guys.
Can you say that one more time, please? I cannot.
Okay.
Policy owner is allowed to pay premium more than once a year under which provision? A mode of premium.
Let's see. Yay, you got it. Oh my God, Yannick, I'm so proud of you. Come on. All right, let's go. A life insurance application must be signed by all of these except policy owner, the agent, the insured, who is an adult, and beneficiary. I didn't mention this, but
beneficiary.
Yes, beneficiary. Absolutely. Good job. All right, I need volunteer. Somebody to help me read. My throat is getting dry. Someone that will be reading fast. Okay, how we go. Any changes made on an insurance application requires the initials of whom? Insured, agent, applicant, beneficiary. Any
Insured.
changes made on an insurance application requires the initials of who?
The insured.
Insured.
Maybe applicant.
No, applicant.
No, the applicant. Yeah, the applicant is a policy owner.
Let's see. Yes, you guys. All right. Weird. Okay, when an applicant make a mistake in the information, blah, blah, blah. Okay, moving on. T applies for a life insurance policy and is told by the producer that the insurer is bound to the coverage as of the date of the application or medical exemptions, whichever is later, provided the T, provided that T okay, something is echoing here. Provided that T is an acceptable risk, what item is given to T? Binding receipt, conditional receipt, warranty receipt, backdate receipt. This is new. T applies for a life insurance policy and is told by the producer that this is strange. I don't think I've come across something like this before. Do you guys have any idea?
What is T?
I have no idea.
Condition.
There's a conditional receipt. At first, I thought they were talking about temporary insurance agreement. However, the direction they said, anyways, let's move on. Okay, M complete an application for life insurance but does not pay the initial premium. All of these actions must occur before M's policy goes into effect, except, so this one now we are looking for a wrong answer, okay? Option 1, policy is delivered. Free look period has expired. Insurance company issued policy. Initial premium is collected. Oof, which one? All this action must occur before M's policy goes into effect, except. Come on, guys. I'm going to go with B.
Yeah.
No, I'm going to go with B. Free look is expired. Initial premium is collected. That have to be taken for policy to be in place. Insurance company issue policy, of course, they have to issue policy. Policy is delivered. Policy have to be delivered. But he doesn't have to finish looking at it for policy to be enforced, right? That's my own take, my 2 cents. And it be like, say, it's like my 2 cents is accurate. All right, moving on. Okay. A non-contributory group term life plan is characterized by option 1, the entire cost of the plan is paid by the employer. The entire cost of the plan is paid for by the employee. The cost of the plan is shared by both employer and employee. And the last option is both employer and the employee must provide evidence of insurability.
Number one.
Number one, yes. Yeah, number one. The entire cost paid by the employer. That's correct. Oh God. Are we watching movie here that we are skipping? Okay, who is not required to sign life insurance application? I think we saw this one.
Yeah.
Adult insured.
Beneficiary.
Policy. Yes, beneficiary. Yeah. Okay. What action should are they repeating? Keep application until premium is. What action should a producer take if the initial premium is not submitted with the application? Why are they calling a producer? Is it the insurance company? That term is not familiar. What action should a producer take if the initial premium is not submitted with application? Well, keep the application until premium is paid. Forward the application to the insurer after giving the application a binding receipt. Forward the application. Sorry?
Applicant, not producer. After giving the applicant.
Oh, sorry, after giving the applicant a binding receipt. Thank you. Now, forward the application to the insurer without the initial premium. And lastly, forward the application to the insurer after giving the applicant a conditional receipt.
I think it was the last one.
Okay, this last one, okay.
I'm not sure because it's like it's repeating.
No.
Yeah, it's repeating, and that terminology they are using, producer or whatnot, is not a terminology that we are familiar with within the life insurance concept. That's why I won't even worry much about this. Okay. August 6th, D submitted an application for a 50,000 life insurance policy and did not pay the initial premium. So when they start giving it like this, so where am I paying? Oh, jeez. All right. So August 6th. So we have application for 50K. And policy and did not pay the initial premium. Then we have August 18. When you have date like this, you want to note your date down. D went to his doctor complaining of chest pain and some tests were given by the doctor. The life policy was delivered by the producer. Okay, so this, I think the producer here is referred to as the agent. Okay, was delivered by the insurance agent on August 20. And D explained what had recently taken place with the doctor. What action should the insurance agent take? Option 1, collect the initial premium. No, option 2, collect the initial premium along with a signed health statement. Option 3, explain the application, explain to the applicant the policy is no longer in effect due to the change in health condition.
Yes.
Option 4,
Option
collect
3.
the initial premium and leave a binding receipt.
Option 3.
No. No, option B.
B, collect the initial premium along with a signed health statement. Okay? Collect the premium along with, that's correct. Okay? So you cannot say, in this situation, the agent should deliver the policy and obtain the premium payment along with a signed health statement. Okay, guys?
Yes.
So the change in her health is not to be considered.
Yeah, that's why that's why the agent collected this signed health statement. All right. So when you send it to the insurance company have any concerns, then they will determine that after they have option to do that is still within the period they can decide. Because we are not the one to decline. It's been approved. It's not our place to decline. Our place is to gather as much information as possible and forward it to the insurance company. All right. If it's employed, oh boy, what's happening here? Okay, if its employee shares in the cost of insurance, what type of group life insurance plan would a corporate have? Non-eligible, non-contributory, eligible, or contributory?
Contributory.
Contributory.
Contributory. Good job, guys. All right. Okay. N, age 50, recently bought an annuity that will pay a guarantee $2,000 per month. At age 70 for life, what type of annuity did N purchase? N, okay, recently bought an annuity that will pay a guaranteed, So is it fixed period, fixed deferred, fixed immediate, or fixed variable?
The fixed period.
Fixed period. Let's see. It's fixed deferred. A fixed deferred annuity pays a fixed amount for life starting at a future date. Okay, so I think we're going to stop here so that I can share with you guys the strategies I want you guys that you can use for your personal study. All right.
Okay.
Okay. So, Violet, are you ready to share your screen, please? Violet? Violet? Oh my God. Violet, you're muted. If you're talking, we can't hear you because you're muted. Oh my God. Okay. All right. I know you're there. Go ahead. We can't hear you. Is something wrong with your volume? Because I can see you're trying to talk. Okay. Is there anybody here who have their study materials open on your computer that you can share with us?
Yeah, mine is open, but I'm disabled. I'm disabled. All disabled participants can
Loudly.
join.
Yes, let me just make you my co-host, Laulu. Laulu, make co-host. Yes, so you can share your screen now, my brother. Go ahead and share your screen. Go ahead. Okay. Okay, perfect. All right, so now go to the landing page of once you're using Remic, right? Because this is the textbook. So if you come out of the
my audio
textbook,
is off. What do you need me to do?
yeah, so go back to where you have the 4 modules.
Okay,
because
the website.
you are inside. Yeah, because you're inside the textbook.
Okay, I'm on the website now.
Okay, so you might want to stop and reshare.
Can you see my screen?
Not yet. We are seeing your screen, but not the page we need to be seeing.
Okay, I'll share again.
Yes, please.
Can you see my screen now?
It's loading. Okay, perfect. So scroll down. Scroll down. Okay. Yeah, so I need you to click on life insurance, for example. Okay. So these are your action items for each modules. And for many of us, you know, when we come here, you want to start reading the textbooks, you want to know, don't get into, if you're already reading the textbook, that's fine. But from my experience, for the purpose of certifications, because we want to get this thing boom, 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 certification done. Because certification is still by REMIC. The questions and answers you solve here is the same questions you encounter in the certification. Because we want to get the certification done, then book the provincial, then we can now go into detailed textbook and then start explaining whatever things that you need to understand at that point. So by that, what you need to get, for those of you that have not yet written your certification, what you can do is, you see, as there are these videos, there are 27 videos, right?
Yeah.
Watch those videos. Also watch the videos, like I'm going to ensure that I post the link to the video for yesterday, and then once the video for today is done processing, I'll also post it. Once you watch this, okay, the next thing, do your case studies. Scroll down for me, my brother. So do this case study and then chapter by chapter quizzes. You see, by the time you do any of this, you see that you get green check mark. Okay, you watch the video, you get green check mark. You do your case study, you get your green check mark. Then you see these same questions that, as you see the way the questions are being asked, the options and everything, you start doing the chapter by chapter this thing. You do that, you get the check mark. Okay, chapter 3, scroll down, please. So by the time you do all the chapter by chapters now, scroll down, and they are not complicated. It's okay. You don't need to score even when you fail it. But when you fail it, read the answers so that when the same questions surfaced again, you already understand the rationale behind it. All right. And then you see that by the time you do all these questions, this thing, you'll be gathering all the check mark, right? And then when you get here, you see, you do this prep quiz. Is very important. Scroll down. So this prep quiz, because we need to do this prep quiz before we can proceed to do the certification. All right. So you need to do all this to get to where we can click on the next, say that, please note that this module will be fully complete once the certification exam has been passed. You can access your certification exam from the main course page or by clicking here. So the recommendation is, once you do this prep quiz and you're scoring 70 to 80%, then you are good to go with certification. Okay? So we have two options here. For tomorrow, ideally, we're supposed to be doing the life insurance certifications tomorrow, but because many of us joined yesterday, so I'm thinking we do chapter by chapter quizzes tomorrow, and then on Friday we write the certification. What do you guys think?
Friday, what time?
During our class like this, because the certification is online. So if you're going to be writing the certification on Friday, you have to prepare your environment ahead of time because it will be proctored. Okay. So for example, and then it will lock down your system. It doesn't take time, maybe 30 minutes, you're done. And
Can it be done at any time?
Sorry?
Can the certification be done at any time of the day?
Yeah, if you are able to do your own, then you come back to share your good news with us during the class. And if you are not able to write us yours during the day, you can do it during the evening. But if we all can write it during the day and come back with our good news, then Friday we move on to ethics.
Oh, okay.
So which one do we want to do? Do we want to do it at our own time during the day and we'll come back with our receipt?
Or can we do it? Can we do it maybe on the weekend on Monday?
See, the thing is that I want us to be done with life insurance certifications now that we've tackled it, especially when we come tomorrow now. We are going to be taking this chapter by chapter pieces from this REMIC. So I make sure I go through, even if I don't complete each chapter, maybe chapter 1, we take five questions from each chapter. By the time we do that, right, and you guys watch that video, and you do what is it called? The case studies video, you'll be good to go, right? So if there's anybody that have not written the certification, and then we move on to start laying the ethics on top of it, you start getting overwhelmed from there.
Yes,
the certification doesn't take time. You can even get it done in 15 minutes, 20 minutes, right? You can wake up very early. You can even say, okay, Friday, I'll wake up early, set your alarm, wake up very early, set up your computer, get it done before going to work. Or if you want to do it during your break time in the office, if you have your secluded office that you can use, you know what works for you, right?
Yes.
So that by the time we come, first of all, take update, okay, how many of us have passed our certification? So once we do all that confirmation, it's the people that have passed their certification that we can move forward with into the next class, unfortunately.
Can we do it even if we are overseas?
Of course, you can do it anywhere. You can do it anywhere, anytime. And even this class, you can join it from anywhere. You just need to remember the time difference.
Okay.
All right. So you guys talk to me. What do you guys think? Because we need to get this thing done, right? So we need to get life insurance done. Once we are done with all this certification, then we book the exams, and then we go into textbook to now start, seeing where we need to cover up in details here and there.
Mr. Joy, for me, it's like this class is now it's like a foundational class for me. So right now I have done these quizzes over and over and over. So all I have is doing check over 30 times. So what I'm looking at, I need something to challenge me more, because I have only like a life insurance to write at provincial. So I'm not sure if you sit down to do all these quizzes, if that will really help me. I don't know. I've done it over and over.
So this phase where we are, you have passed this phase. So you may not, because you've written your certification already. So this one is applicable to those that are writing. So the phase that is going to be more is when we get to the interface, when we are done with all the certification and we start digging deeper into the deeper studies and getting ready for provincial. I guess that aspect will benefit you more. Right? And if you've done this again and again, I don't know. I don't know what to say to you.
Exactly, because that's why I was saying if you can give us if there's a way you can bring out a question, even if it's one or two, the way they set during provincial exams, because that question honestly is so tricky. It is so tricky. So even if it's one or two, then let me just try again, relax, because then it's so tensed. Relax and see how to answer.
Because what I'm going to do is, once we've passed all the certifications, so by the time we are studying for provincials, I'm going to, oops, I'm still recording, so I'll stop recording.